If I had to start buying stocks today, knowing what I know about this market rebound, the AI infrastructure boom, and the way money is starting to rotate underneath the surface, I would not just chase the biggest green candle on my screen. Most people think a hot stock list is about finding the name that already ran the most and hoping it keeps running. But that is not investing. That is emotional shopping with a brokerage account. What I would do instead is look for the companies sitting where the real spending is still happening, where customers are still ordering, where management is fixing something broken, or where a bottleneck is becoming so serious that somebody has to get paid to solve it. And that is exactly what this list is about. 5 stocks for May, but not 5 random tickers. These are 5 different ways to understand where the next pocket of upside might come from. Today is Friday, May 1st, New York time, and comment what day and date you are watching from. And quickly, if you value my content, support the channel by subscribing and comment John A.G. Best below. It tells me you want the real work, not the recycled noise. Now we have to start with the market itself because this is where a lot of people get trapped. When stocks bounce hard after a rough stretch, everybody suddenly becomes brave again. The same people who were scared 2 weeks earlier start acting like they saw the whole move coming. They did not. They just got louder after prices went up. The better question is this: what part of the move is real and what part is just people chasing? In late March and early April, the market looked like it was losing confidence. Tech was wobbling, AI winners were getting questioned, small caps were still trying to find a floor. Then the story changed, buyers came back, and the market started rewarding companies tied to actual spending. Not just AI slogans, actual orders, actual infrastructure, actual customers. That distinction matters, because the first AI trade was easy to understand. Buy the biggest chip leader, buy the obvious winners, buy anything with AI in the slide deck. But the next stage is messier. It is packaging, it is cables, it is power, it is cooling, it is memory, it is rack scale systems. It is the boring stuff that makes the glamorous stuff work. One more thing matters here. Interest rates are still part of the background, even when nobody wants to talk about them. When investors believe cuts are coming, growth stocks usually get more oxygen because future earnings look more valuable. But if inflation stays sticky, that oxygen can disappear quickly. That is why I do not want a list built only on hope. I want companies where there is a business reason for demand. A coffee chain fixing service. A packaging company supporting more complex chips. A connectivity company moving data with less waste. A photonics company trying to solve heat and bandwidth. A chip designer trying to give hyperscalers another serious choice. That is a better framework than simply saying the market bounced, so everything must go up. That is how you avoid confusing fast momentum with a real thesis. And then, oddly enough, the first stock on this list is not even an AI stock. It is Starbucks. Now, I know, that sounds strange. We are talking about data centers, chips, and artificial intelligence, and then suddenly we are standing in line for a latte. But stay with me because this is the stock that reminds you every rally does not have to be a chip rally. Starbucks is a turnaround story. It is not about inventing a new product category. It is about fixing the customer experience, improving store flow, and proving the brand still has pricing power. For a while, the company had a problem that regular customers could feel. Orders were slow. Stores felt crowded. Mobile orders created friction. The brand was still powerful, but the experience did not always match the price. That is where Brian Niccol comes in. The plan is not complicated. Make the stores run better, improve service speed, add staff where needed, simplify the work behind the counter, bring back the feeling that Starbucks is a small daily luxury, not just a chaotic pickup counter. And based on the latest public numbers, this is no longer just a promise. Global comparable sales rose in the mid-single digits. North America was stronger than that. Revenue grew high single digits, and earnings came in better than expected. The real surprise was not just sales. It was that the bottom line started showing life sooner than many people expected. That changes sentiment. When a turnaround spends money, investors wait for proof. When proof starts appearing, they reprice the story. Now, the skeptical side is obvious. Labor costs are still high. Coffee costs can pressure margins, and consumers are not unlimited ATMs. So no, Starbucks is not suddenly a perfect business. But if traffic improves while service metrics improve, the stock can keep getting a second look. That is stock number 1, the consumer comeback. Stock number 2 moves us into the engine room of AI, Amkor technology. This is one of those names that does not sound exciting at dinner. Nobody says, let me tell you about outsourced semiconductor assembly and test, unless they are trying to end the conversation. But in this market, boring can be beautiful. Amkor helps package and test semiconductors. That matters because modern AI chips are not just chips sitting alone on a board. They are complex systems that need advanced packaging, memory integration, heat management, and reliability. As AI models get bigger, the package around the chip becomes part of the performance story. According to recent company updates, Amkor just delivered record first quarter revenue, helped by broad demand and progress in advanced packaging programs. The company specifically serves areas like data centers, artificial intelligence, autos, wearables, and phones. That tells you this is not a one-product bet. It is a supply chain business sitting behind multiple end markets. Now, here's the trick with Amkor. The stock can move fast because investors are trying to price in AI packaging demand before it fully shows up. That creates opportunity, but also danger. If expectations jump too quickly, even a good report can lead to a pullback. So the question is not, did it already move? The question is, are estimates still moving up because the business is actually improving? If the answer is yes, then pullbacks can become interesting. If the answer is no, then it is just another crowded AI trade wearing a different costume. That is why Amkor matters. It is not the face of AI. It is part of the plumbing. And sometimes the plumbing makes more money than the showroom. The third stock is Credo Technology, ticker CRDO. Now this one is about connection. And connection is becoming one of the biggest hidden problems in AI. Everybody talks about compute, but compute has to communicate. GPUs have to pass data. Servers have to talk to other servers. Racks have to move massive amounts of information without burning too much power. Credo sells high-speed connectivity solutions, including active electrical cables. Think of these as smarter copper connections that help move data efficiently inside AI infrastructure. They are not glamorous, but they can be incredibly important inside large data centers, where power, speed, and reliability all matter at the same time. The latest reported quarter was huge. Revenue was up more than 200% from the prior year, sequential growth was strong, margins were high, and management pointed to continued strength in active electrical cables and related products. That kind of growth gets attention, but it also creates a problem. When a stock becomes loved quickly, valuation gets stretched quickly. So even if the business is excellent, the stock may need to digest the move. This is where investors have to separate company quality from entry price. There is another piece too. Intellectual property disputes had been part of the story. When a company has valuable technology, ownership questions can weigh on the market. If those questions get resolved in a way that strengthens the company position, then investors start treating revenue as more durable. That is why Credo has been so explosive. It is not just cable demand. It is cable demand plus legal clarity plus AI spending plus investors realizing that the back end of AI infrastructure is becoming a serious market. But again, I would not pretend risk disappeared. Customer concentration matters. Competition matters. Valuation matters. And after a big move, one soft guide can hit the stock hard. So Credo is exciting, but it is not a sleep-easy name. Now the fourth stock is the most speculative one on the list, Aeluma, ticker ALMU. This is not a giant. This is not a proven compounder yet. This is an emerging photonics and semiconductor technology company trying to commercialize something that could matter a lot if the data center upgrade cycle keeps moving the way people expect. Aeluma works with compound semiconductors, photonics, and quantum dot lasers. In normal language, the company is trying to help move information using light in ways that may be faster, cooler, and more efficient than older approaches. That matters because AI data centers are running into real physical limits. Heat is a limit, power is a limit, bandwidth is a limit, space is a limit. When people say AI is software, they miss the physical part. AI needs buildings, chips, electricity, cooling systems, cables, and optical links. It is very physical. Recently, Aeluma received a NASA award tied to integrated quantum dot lasers, using its manufacturing approach to support next-generation silicon photonics. The company says its platform is aimed at markets like AI infrastructure, defense, aerospace, consumer sensing, robotics, automotive, and quantum technologies. That is exciting. But let me slow it down. A government award is not the same thing as scaled commercial revenue. A promising platform is not the same thing as a durable business. A small cap stock can double on excitement and then cut in half when patience runs out. So Aeluma has to be treated differently from Starbucks or AMD. To me, this is a future bottleneck play. If data centers eventually need major upgrades to reduce heat and improve data movement, photonics companies could become very important. But timing is everything. Being early can feel exactly like being wrong. So with Aeluma, the question is not, can the idea sound big? Of course it can. The question is, can the company turn the idea into production, customers, revenue, and repeatable margins? Until that happens, this is high risk, high potential, and absolutely not something to treat like a safe blue chip. Now we get to the final name, and this is the one most people came for. Advanced Micro Devices, AMD. AMD is probably the cleanest big cap way to say, I want exposure to the second serious AI accelerator platform. Not the leader, the challenger. And that difference matters. NVIDIA still has the dominant ecosystem. It has the software advantage. It has customer trust. It has the first mover benefit. You do not beat that by simply launching a chip and hoping Wall Street claps. But AMD does not need to destroy NVIDIA to win. It just needs AI demand to be large enough that customers want another serious supplier. And that is exactly what appears to be happening. AMD and Meta recently announced an expanded partnership for multiple generations of AMD Instinct GPUs, with first deployment shipments expected in the second half of the year. Using a custom MI450-based GPU, 6th generation EPYC CPUs, ROCm software, and the Helios rack scale architecture. That is the key phrase. Rack scale. Hyperscalers do not just want chips in boxes. They want deployable systems. They want performance at scale. They want power efficiency. They want supply security. They want alternatives. AMD Helios is designed to be a rack-level AI platform built around next-generation Instinct GPUs. In company materials, the system is described as delivering massive memory capacity, huge bandwidth, and performance aimed at training and inference workloads. This is why AMD matters now. It has a GPU story, a CPU story, and an AI PC story. The GPU story is about accelerator demand. The CPU story is about inference and data center workloads. The AI PC story is longer term, but if devices begin running more AI locally, AMD could benefit there too. But here is the honest counterpoint. AMD still has to execute, ROCm has to keep improving, customers have to deploy at scale, margins have to make sense, and investors have to see revenue convert from promise into numbers. The market will not give AMD unlimited credit forever. So I would not buy AMD just because somebody says it can multiply. That is lazy. I would watch whether large customers keep signing, whether shipments stay on schedule, whether data center revenue accelerates, and whether guidance confirms the story. Because if that happens, AMD does not have to become the king, it just has to become unavoidable. So what is the full picture? Starbucks is the turnaround. Amkor is the packaging backbone. Credo is the connectivity winner. Aeluma is the speculative photonics bet. AMD is the large cap challenger, trying to turn AI demand into a platform story. Different stocks, different risk levels. One common lesson. The market is paying for companies that solve real problems. Not every stock with AI in the sentence deserves your money. Not every stock that jumped is too late. Not every small cap is a hidden gem. And not every big cap is already fully priced. You have to separate story from evidence. If you are conservative, you probably start with the companies that already have sales, customers, and earnings power. If you are aggressive, maybe you look at the smaller names, but you size them like speculation, not certainty. And if you are building for years, you stop asking, what ran this week? And start asking, what bottleneck will still matter 2 years from now? That is the investor mindset. If you are successful, share your success story in the comments so others can stay motivated. And tell me below, which one would you rather own through the next AI cycle? AMD, Amkor, Credo, Aeluma, or Starbucks? Also, which one do you think is already too expensive after the move? This is for education and research only. I am not your financial advisor, and this is not a signal to buy or sell anything. Use this as a starting point, check the filings, study the risks, and make decisions based on your own plan, not just because a stock sounds exciting in a video.